7 worst financial tips that you'll ever hear. What's the worst financial advice that you've ever received? I'll go first. Avoid risk and only make safe investments. In reality, avoiding market risk entails accepting inflation, and this is just one example. There is no shortage of poor financial advice. To get some, just ask your broke coworkers for money advice, or talk to your crazy uncle who swears that he can time the market. Worrisome, though, is that some bad pieces of financial advice are so widely shared and praised that they pass off as good advice. So let's bust some of those myths. In today's video, we will look at 7 of the worst pieces of financial advice that you might hear, along with the steps that you can take to avoid the financial missteps they will cause. Make sure to stick around till the end of this video because some of these financial tips are related to each other and can change your life for the better if you use them all together. So let's get straight into the video. Number 1. Carry a credit card balance. The first piece of advice is all about keeping a good credit rating. The idea here is that keeping a balance on your credit card month after month will help your credit score, and this will eventually give you a better credit rating. So why is it wrong? First of all, your credit card balance doesn't have much of a positive effect on your credit score. Yes, carrying a balance is part of credit utilization, but so are your payment history, the length of your credit history, the types of accounts you have, and how many credit checks you've had recently. In fact, most credit scoring systems look at payment history more than anything else, not how much credit you use. In fact, credit scores like it when you use less than 30% of your available credit. In other words, they want you to have a balance that is equal to or less than 30% of your credit limit. When you carry more than 30% of your credit limit as a balance, your credit score goes down. Worse than that, if you carry a balance, you have to pay interest, which is money right out of your pocket. You also risk late fees and a bad mark on the payment history part of your credit report. A much better strategy is to use a credit card with a good bonus program and pay off the balance in full every month. If you do that, you get all the credit benefits of having a credit card. You don't have to pay interest, you don't have to worry about paying late fees, and you get the most out of your bonus program. This is how you use a credit card. Number 2, don't waste money on conveniences. Some financial experts strongly urge people to stop spending money on products and services that make life easier. They think that those conveniences will make life harder in the long run. As part of this, there has been an attack on everyday comforts, like buying a $5 latte on the way to work. Does spending $5 on a latte or $20 on house cleaning really make a dent in your budget? What if instead of cleaning your home for 3 hours, you spent 3 hours building a side business that could earn you thousands of dollars annually? Yes, if you do it yourself, you can save money, but then you have less time for friends, family, or things like self-care. So if you can afford to outsource tasks that don't cost you much money to outsource, but cost you a lot of time to do yourself, go ahead and do it. Paying someone to free up your own limited time allows you to focus more on your family and earn more by devoting more time to your work. Number 3, there is good debt and bad debt. Many authors in the field of finance have a tendency to label debts as good or bad based on a variety of criteria. Is there such a thing as good debt? To put it simply, there is no good debt. There are times when it makes sense to borrow money, but once you have it, it's like having a weight around your neck. Why is it a good idea to borrow money? Borrowing money can make sense if it will directly increase your long-term earnings, like a loan to start a business, or lower your long-term costs, like your first mortgage. Other than those instances, the debt becomes a burden, and your new goal should be to keep the interest rate on that debt as low as possible and pay it off as quickly as you can. When you pay off a debt, you get rid of a monthly bill that reduces your cash flow. It also means you're no longer losing money to interest, even if it is a small amount. Instead of believing that there is good debt and bad debt, decide that it's okay to borrow money that directly increases your income or decreases your expenses in the long run. But focus on getting rid of the resulting debt as quickly as you can. Sometimes it makes sense to borrow money, but there is no such thing as good debt. Number 4, rent money is dead money. If you pay rent, the money you pay goes straight to the landlord, so isn't that just throwing money away? Many people suggest that we should get a mortgage almost as soon as we get out of college so that we don't waste money on rent. People who own homes also spend a lot of money to keep up their property. When you own a home, you have to pay for mortgage insurance, property taxes, homeowners insurance, homeowners association fees, and home and property maintenance. Most of the time, these costs add up to a lot more than what it would cost to rent a similar property. The most important question is, how long will you stay in that house? It's easy to move out of a rental if you have to move for work or some other reason. On the other hand, if you own a house, you have to deal with trying to sell it at the same time you're making other big changes in your life. You can't just go to the bank, sell your house, and get the money right away. If something goes wrong, this can put you in a tough spot if you have a big mortgage. There is a possibility that the value of your home will go up while you own it. But unless the housing market is red hot or you have a very small mortgage compared to the value of the house, this won't make up for the difference between how much you pay in rent and how much you pay in a mortgage each month. The fact is, you should rent instead of buying unless you plan to live in the same place for at least 5 years, or if your monthly mortgage payment is at least 25% less than what your rent would be. There are times when it makes sense to buy a house. Purchasing a home can make a lot of sense if you have a steady job and are willing to buy a starter home when interest rates are low. Home ownership makes sense if you've gotten a nice windfall or have saved enough money that will have a small mortgage or none at all after you buy. Number 5. Getting a tax refund is bad. When tax time comes around, everyone talks about what they'll do with their refund. The average tax return is right around $2,000. Some families are paying off debt with it. Others can't wait to use the money to pay for their summer vacation. Some families will use it to set up their first savings account. In reality, there are many ways to improve your financial situation with a tax refund. Still, many financial experts say that getting a tax refund is bad because it means that people give the U.S. government a free loan all year long. People are just getting back their own money, which they shouldn't have given to the government in the first place. But most financial habits are based on behavior rather than math. For many people, getting a tax refund is the only way they can save some money every year. A recent survey by Go Banking Rates found that 69% of people have less than $1,000 saved up. So I don't think it's a bad thing at all if a tax refund is the only thing that makes people save. Number 6. You don't have to know what we're doing. We are the professionals. If financial experts tell you this, turn around and run as quickly as you can. You want your money advisor to inform you of your investment and financial possibilities. Find second opinions if your financial advisor is unable to explain to you in plain English exactly what you are purchasing and why you need it. This is not to mean that you must be an expert in finance yourself and comprehend all the intricacies of a detailed financial strategy. This means that your advisor should be able to answer your queries on why you're investing in what you're investing in. You would probably seek a second opinion if you drove your car to a mechanic and he told you that the motor needed to be changed, but that he couldn't tell you why. Here, the same logic should hold true. If your financial advisor cannot explain your investment to you in simple layman's terms, they most likely do not fully understand the financial advice they are giving to you themselves. People who are just repeating something they heard someone else say will not be able to give details of how they came up with that idea. Whereas it is their original idea, they will be able to explain it in a much more detailed way. Number 7. You should cancel your whole life insurance policy and get a term policy. Insurance salesmen are always happy to try to get you to buy a whole life policy, and they usually have a very good sales pitch as to why you should. Unfortunately, many people find out that the whole life policy they bought a few years ago doesn't really meet their needs. When they ask for help, they are only told to get rid of that whole life policy right away and get a term policy. There are a number of reasons why it might not be a good idea to just drop that whole life insurance policy you already have. If you don't have whole life insurance already, of course you can get a term policy and invest the difference yourself to get a higher return. First, most of the fees are paid up front on a whole life policy. There are surrender charges on many policies for the first 10 years or so. You will have to pay a fine if you give up the policy during that early time frame. This means that if you've had the policy for a few years, you've probably already paid off all the commissions and your returns are stable. Once the initial charges are paid, many policies, especially older ones, have a reasonable guaranteed return. There are numerous pre-2000 policies with guaranteed annual returns of 6%. If you have that, you probably should not change it. You should look at your policy to see what kinds of returns are guaranteed by it. If the returns are better than what you can get easily elsewhere, you should keep the policy. So what is the worst financial advice that you've ever received? Tell us in the comments, and don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.